Success stories. Big wins in vulture investing history. Welcome back to the Art of Vulture Investing. So far, we've covered what vulture investing is, how to find distressed companies, what happens in bankruptcy court, and how to exit successfully. We've even looked at the risks. Now, in this final episode, let's end on a high note. Today, we'll explore real-life success stories where vulture investors made smart moves and earned huge profits from companies that most people thought were worthless. These examples show that when done right, vulture investing can be incredibly powerful. Case study number 1, American Airlines. In 2011, American Airlines filed for bankruptcy. It was one of the largest airlines in the U.S., but rising fuel costs, high debt, and tough competition pushed it to the edge. Most investors thought the airline was finished. But vulture investors saw something different. They noticed the company still had loyal passengers. Its routes and landing slots were valuable. There was a chance for merger with another airline. They bought Americans' distressed bonds and shares when prices were extremely low. Then, in 2013, American merged with U.S. Airways and exited bankruptcy stronger than ever. Those who had bought during bankruptcy made 5x to 10x returns on their investment. Case study number 2, WorldCom, MCI. In the early 2000s, WorldCom, a telecom giant, went bankrupt due to one of the biggest accounting scandals in U.S. history. Many investors ran away from the mess. But vulture investors dug deep into the financial filings and court documents. They realized that the network infrastructure and customer base were still valuable. They bought bonds and debt at a deep discount, sometimes for just 10-15 cents on the dollar. Later, the company rebranded as MCI and was sold to Verizon. The investors who bet on the recovery walked away with massive returns. Some made 6 to 8 times their money. Case study number 3, General Motors. In 2009, during the global financial crisis, General Motors, GM, filed for bankruptcy. It was unthinkable, a car company that had been around for 100 years. But the U.S. government stepped in to help restructure GM. New management was brought in, operations were cleaned up, and assets were sold. Vulture investors bought GM's old bonds and shares when prices were at their lowest. When GM came back as New GM in 2010, it launched an IPO and the prices shot up. Those who held on during the tough times made double or triple their investment. Case study number 4, Sears Real Estate Spinoff. Sears, the once mighty retail chain, was in decline. Sales were dropping, and the company had too much debt. But sharp investors noticed something valuable: its real estate. Sears owned many of its stores and malls, often located in prime city areas. Vulture investors pushed for a spin-off of these properties into a separate company called Seritage Growth Properties. Even as Sears collapsed, the value of these real estate assets rose. Investors who bought Sears shares for the real estate opportunity ended up making large gains, even though the retail business failed. George Schultze's real case. Collins and Aikman. George Schultze invested in Collins and Aikman, an auto parts company that went bankrupt. Most people ignored it, but George saw value in its relationships with major car manufacturers and its production assets. He bought distressed debt at a low price and got involved in the bankruptcy process. Eventually, he and other creditors recovered value through asset sales and settlements. It wasn't the biggest win, but it was a disciplined, smart recovery that protected investor money and earned a strong return. George's lesson: don't go for flashy wins. Go for repeatable success. What these success stories teach us: all these cases had one thing in common. Everyone thought the company was doomed. Vulture investors looked deeper and saw hidden value. They had patience, legal knowledge, and a clear exit plan. This is why vulture investing is not gambling. It's not about luck. It's about strategy, timing, and bold thinking. How you can learn from these stories. If you want to apply these lessons, start by studying past bankruptcies. Learn what worked and what didn't. Practicing analysis. Read financial statements and legal filings. Building your watch list. Track struggling companies with potential. Staying rational. Don't chase hype. Follow logic and evidence. Always plan the exit. Know when and how you'll get out. Final thoughts on vulture investing. Vulture investing isn't for everyone. It takes patience, legal understanding, and the ability to stay calm when others panic. But when it works, as we've seen in today's episode, the results can be life-changing. George Schultze and other vulture investors show us that there is always opportunity in failure if you know where to look. What you learned today. Vulture investing can lead to massive wins in bankruptcy situations. American Airlines, GM, WorldCom, and Sears are examples of profitable recoveries. George Schultz's disciplined approach helped protect capital and grow it. Success comes from strategy, patience, and careful research. Thank you for watching the series. This was Episode 8, the final chapter in the Art of Vulture Investing series. We hope you've enjoyed learning about what vulture investing is, how distressed assets work, the legal system behind bankruptcy, how to profit and manage risks, real-world case studies of success. If you've learned something valuable, please like, subscribe, and comment below. Let us know which investing topic you want us to cover next. Thank you for watching.